For decades, Japan was the exception. While the rest of the world moved through inflation cycles, rate hikes, and recessions, Japan stayed frozen in time. Zero interest rates, endless stimulus, and cheap money quietly flowing into global markets. But that era may finally be ending. A snap election delivered one of the strongest political mandates Japan has seen in decades. Interest rates surged almost immediately. Bond markets reacted. And one of the most important pillars of global liquidity, the Japanese carry trade, is now under real pressure. Today, we're breaking down what changed, why it matters, and how Japan's shift could reshape stocks, currencies, and global markets in ways many investors are not prepared for. In early 2026, Japan entered a new political era. Sanae Takaichi, a longtime power broker inside Japan's ruling Liberal Democratic Party, called a snap general election shortly after becoming Prime Minister. The result shocked both political analysts and financial markets. Her party didn't just win. It secured a two-thirds supermajority in Japan's lower house of parliament. That matters more than it sounds. A supermajority dramatically reduces political resistance. It allows a prime minister to pass budgets, push reforms, and implement policy without relying on fragile coalitions. In practical terms, this is one of the strongest governing mandates any Japanese leader has held in the post-war era. And markets immediately understood what this meant. Policy risk dropped, policy action became possible, and Japan's long-standing economic assumptions were suddenly back on the table. Even before the election results were finalized, markets began positioning. Traders quickly coined a phrase: the Takaichi trade. At its core, Takaichi's economic vision challenges decades of caution. Japan has lived with weak growth, low wages, and deflationary pressure for years. Takaichi argues that this caution has gone too far. Her platform includes aggressive fiscal spending, targeted tax relief, and direct support for domestic industry and wages. But the most important signal was this: she has shown openness to monetary normalization, not reckless tightening, but a recognition that emergency-level policy may no longer be appropriate forever. Markets reacted quickly. Japanese equities rallied. The Nikkei 225, Japan's stock market index, pushed toward record highs. And bond yields, long dormant, began to move. This wasn't just optimism, it was a repricing of Japan's future economic path. To understand how significant this moment is, you need historical context. For most of the last 30 years, Japanese interest rates were pinned near zero. In some periods, they were negative. The Bank of Japan capped bond yields. It intervened directly. And it made clear that rising rates were unacceptable. That policy became foundational, not just for Japan, but for global finance. Then came the election. Post-election, long-dated Japanese government bond yields surged. Some securities reached levels not seen in decades. This move wasn't driven by a single data point. It was driven by expectations. Expectations of fiscal expansion, expectations of stronger growth, and expectations that the Bank of Japan may no longer suppress yields at any cost. In simple terms, markets tested Japan's resolve. And for the first time in a long time, Japan didn't immediately push back. Now we get to the heart of the global impact, the Japanese carry trade. Here's how it works. Japan offered the cheapest borrowing costs in the world. Investors could borrow yen at near zero interest. They would then convert that yen into higher-yielding currencies, like the US dollar, and invest in assets with better returns. This strategy became systemic. The yen carry trade helped finance US equities, emerging market debt, corporate credit, real estate, and even alternative assets. As long as Japanese rates stayed low and the yen stayed weak, the trade worked beautifully. For decades, Japan quietly subsidized global risk-taking. But the carry trade has a critical weakness. It only works when borrowing costs stay low. When Japanese rates rise, even slightly, the math changes. Borrowing yen becomes more expensive. Leverage becomes riskier. Currency volatility increases. At a certain point, carry trades stop being attractive. Investors begin to unwind positions. Assets get sold. Yen gets bought back to repay loans. That process drains liquidity from global markets. This is why Japan's rate shift matters far beyond Tokyo. It represents the slow dismantling of one of the largest sources of cheap money in modern financial history. Not with a sudden crash, but with a gradual tightening. So what does this mean going forward? For Japan, the story may actually be positive. Stronger growth, higher wages, more domestic investment. That can support Japanese equities. Globally, the picture is more complicated. Higher Japanese rates mean less leverage, tighter liquidity, and greater sensitivity to risk. Assets that benefited most from easy money may face headwinds. In currency markets, the yen becomes far more dangerous. Even small moves can trigger forced deleveraging across institutional portfolios. And in bond markets, rising Japanese yields compete directly with US and European debt, quietly pushing global yields higher. This isn't a crisis, but it is a regime change. Japan's post-election interest rate shock may look like a local story. It isn't. A powerful new prime minister, a historic supermajority, rising yields, and the gradual unwind of the world's most important carry trade. Together, they point to one conclusion. The global financial system is entering a new phase, with less free money, less leverage, and more consequences. If you found this breakdown useful, hit like and subscribe. And let me know in the comments, is the Japanese carry trade truly over, or is this just the first warning shot? Thanks for watching.